Hey guys, welcome to our financial future. In this video, we're going to go over how to find stocks, what you need to look for, and the one thing at the end of this video is I'm going to show you how to exponentially grow your watch list. Let's get into this. In this video, we're going to go into some basic things that you should already know about stocks. So if there are some things that you are unfamiliar with, please go review my stock market course so you can catch up to speed. So let's get into the review of the things we need to know before we even go out looking for a stock. We need to know what kind of companies are out there. Are they big? Are they small? Are they stable? Are they growth? Or are they even speculative? Are they a blue chip stock or a growth company? Are they stable and pay a dividend, or are they even a defensive or consumer cyclical kind of stock? Maybe you're a beginner investor and you don't want to take a lot of risk and you want to get into bonds or possibly put your money in mutual funds. If you know those things, then you're off to a good start. But there are going to be a lot more things you are going to have to know before you even think about going out and looking for stocks. You're going to have to know what your circle of competence is. Your circle of competence is your unique information that you've gathered over your lifetime that can apply to knowing more about a business or a product. For example, you could have an iPhone or a MacBook and you know about Apple's products. So you have a little bit of insider information on how customers will react to their product because you have an opinion. Your circle of competence isn't just narrowed down to this field. You can grow your circle of competence with books and podcasts. You need to know how to spot a moat or a competitive advantage. A moat or competitive advantage is something that gives a company an edge that would help them compete in the world and not suffer revenue loss to another company that is competing with them. For example, a company like Apple makes very quality products that people are willing to pay more for, so that gives them an advantage over other companies. Amazon, for example, can price their things very low, so they can compete with people like Walmart. You're going to want to know how to properly build a watch list. This is very important to keep track of the companies when it comes to news and building your future story and getting price alerts when the stock gets to a certain point that you wanted to buy at. Also being able to know how to do research in a company, all the way from going to their annual report, just to figure out all the ways this company makes money with their products or services. You have to know what the financial statements are. Finding a stock is going to be very useless to you if you do not know how to read these. You will have to interpret them to know how much cash or debt they have to be able to understand if they will be able to survive. These statements are things like the income statement, the balance sheet, and the cash flow statement. If you know how to find a stock but don't know how to build your portfolio, you are putting yourself at a huge risk and could miss out on a buying opportunity on a company if you don't have enough cash. Lastly, management. You're going to have to know that the management is able to run the business and make good decisions and have a CEO with a very strong mindset and great work ethic. Management solely can run a business right into the ground. Now onto the meat of this video, but I had to do that because if you do not know those things, you will not know how to spot a good stock. We're going to learn a little about ETFs. It's what's inside the ETF that interests me, not the ETF itself. ETF stands for Exchange Traded Fund, and these are traded on the stock market like a stock, but they track an industry that has a large group of companies inside of it that help you be diversified, exposing a little less risk. But we're going to go why they aren't really the best option in my opinion and how to build our own strategy. ETFs are filled with stocks, and not just any stocks. Professionals pick these stocks. They go out and find the stocks and put them in a basket that will possibly give us the best performance. And this can help us find companies within our circle of competence when we go into these ETF and look into the specific industries they follow. So let's get into this. So we know about our circle of competence and that we know we need to search in certain industries. So we're going to go over to my computer and I'm going to show you the biggest way to find a great boatload of stock. So what we're going to want to do is go to Google, and when we get there, we're going to go to ETF.com. And this will take us to a website that just covers pretty much ETFs and teaches us about ETFs. Where we want to click is ETF Screener Database. It's going to give us this page, and along the left-hand side here, you will be able to find certain characteristics about the ETF that you're looking for. And you can look at asset classes, where it shows you like commodities and currencies and fixed incomes and equities, which are, if you want to buy an ETF that are specific to those, you can look them up. You can also click down here on category, which can give you stuff like agriculture. And you can go down and see like energy down here. But where we really want to focus our attention is on the niche section here. So just like our circle of competence, this is going to give us categories that narrow things down into stuff we know about. So if you are interested in aerospace and defense, like military stuff or planes, then you could go into that. Autos, agriculture, biotech, cannabis, construction. If you're a carpenter, for example, or engineering, that would be part of your circle of competence, so you can type in there. And then I'm going to click on something that a lot of people do know about here, and it's video games and esports. And we're going to just check this out. Expense ratio. So that is money you're going to spend annually on your invested capital. So for example, if you had $1,000 invested, you would have to pay $5.50 every year. And if that number keeps going up, then the more you pay. So if you had like $10,000, you'd be paying $55 a month. Assets, AUM just means assets under management, and shows you how much money people have pooled into this ETF. So we're going to click on it here. And we're going to see some information here on the left-hand side, like who issued the ETF, when it was created. Open-ended fund just means that an unlimited amount of people, well, maybe not unlimited, but yeah, an unlimited amount of people can invest in this, stick their money into it. The average spread is the percentage between the bid and the ask price. And the average volume is showing you how much money comes into it. And you can just scroll your mouse and it'll tell you each one of what these mean. And we'll just keep going down to where the important information is. Like here, it shows you where the price has gone up. And then you want to click on, it should say the top 10 holdings weighted, but we're just going to click on here because it's going to make them pop up. So you can see here, it's showing us the holdings and how much is allocated. So here, NVIDIA, which is a pretty known company, has 8.99% of this whole portfolio, essentially the whole basket. And then you go down, you have Tencent, Sea Limited, Advanced Micro Devices, Activision Blizzard, they make video games. So anything to do with gaming and esports is a company that's in here. So you can see how many companies take up this ETF. And there's probably going to be names like Pearl Abyss Corp that you've probably never even heard of. And down here at the bottom, you can see a company called teach.So. So if NVIDIA went up 10, or NVIDIA went down 10%, and teach.Co went up 100%, those two companies would just offset each other. Shows you that like if this company had huge gains, it's not going to help your ETF too much. So one thing we want to kind of compare this to, and this is why I don't really like ETFs, is because of how many companies that really don't affect what is going to go on. So we can look at this one. This is a technology ETF that I pulled up. You have like Apple, Microsoft, Visa, Cisco, Adobe, Nvidia's in there as well, PayPal. But then you come down, you can see how many companies are in here that affect this ETF. But you also want to look at like 0.2, 0.1%. So benchmark electronic affects this ETF 0.01%. And it doesn't really make any sense to invest in something like that, especially since you can't know all of these companies. Yes, a professional is picking them, but also a professional is telling me that he's very bullish on Apple and wants almost 19% of that portfolio to be in there. So I'm going to go back and talk to you about how we should look at this, because if Nvidia is the majority of this ETF, then that professional is going to be bullish on it, and we want to probably take a look at who Nvidia is, what they do if we're into gaming, and then try and understand that company. I'm going to give you a personal strategy of myself that I think that can be better. Because when you are a long-term investor, you're only going to pay for trading fees. With an ETF, you're going to have to pay that expense ratio. And if it's a good ETF, you're just going to keep on having to pay them more for that expense ratio and building that ETF for you. These things are just products that these people build to make money off. A strategy out there is maybe take like 5% of your portfolio and go into that industry that you're interested in. So you'll be able to find these companies in those ETFs that you're looking at and go through some of those companies that have possibly the highest weighting in the ETF, because that will be what the professional is most bullish on when he picked it, and go and research that company. Go into the annual report and see what that company does and learn about them. And then what you want to do is build your own ETF of like 2 or 3 or 4 of the good companies, so that you are getting diversified in that industry. So you could pick 3 and 1, 3 good companies that have growth that might be a little bit more risky, or 1 defensive one, or 2 growth ones and 1 defensive, or 2 defensive and 1 growth. And this is a very good strategy, because if one of them doesn't do good and then the other one does because they're competitors, you'll still have that defensive and you'll get 1 growth and 1 that doesn't perform as well. But like we know, a rising tide lifts all boats. So we will want to use that to our advantage by sticking within the same industry. And for all we know, all those companies could go up and the industry could just grow together. This strategy also gives you the flexibility that an ETF doesn't. For example, if you want to sell one of these companies in your personal basket, then you can and replace it with another. With an ETF, you can't do that. You have to sell the ETF or some shares or something like that. You can't just get out of a company that's in the ETF. So this has a very good advantage over buying an ETF and paying that expense ratio when you can just do it yourself. Thank you so much for watching my videos. I hope that you learned a lot about what you need to do to go out and find stocks, an introduction to ETFs, and what to look for when you're inside of them. I hope that you enjoyed this video, and I'll see you in the next one.